FOMC, first pause since July 2025. Negative 92,000 jobs versus positive 60,000 forecast. $90 oil kills rate cuts. The Fed was supposed to cut. Then 92,000 jobs disappeared. That single moment just shocked the financial world. Investors expected interest rate cuts. Markets were already celebrating. Stocks were rising on the assumption that cheaper money was coming. And then suddenly, everything flipped. So what just happened inside the economy? And why are investors around the world suddenly nervous again? Let's break it down. For most of the past year, the economic story looked relatively stable. Central banks had raised interest rates aggressively to fight inflation. Those higher rates slowed borrowing, cooled spending, and gradually helped push inflation downward. It was painful for mortgages, credit cards, and business loans. But the strategy seemed to be working. Inflation was easing. Economic growth was slowing but not collapsing. And the job market remained surprisingly strong. Because of that, investors began preparing for the next phase of the cycle. Rate cuts. Lower interest rates would mean cheaper borrowing, easier access to credit, and more money flowing into businesses and financial markets. Historically, when central banks begin cutting rates, stocks tend to rise because liquidity increases. So markets began moving early. Investors poured money into equities. Tech companies rallied. Analysts began predicting multiple rate cuts within the year. But then the economic data delivered a shock. Economists expected about 60,000 new jobs to be added to the economy. Instead, the report showed something very different. Negative 92,000 jobs. Instead of growth, the economy lost jobs. That's not just a small miss. That's a swing of more than 150,000 jobs compared to expectations. Numbers like that force investors to reconsider everything they believed about the economy, because the job market is one of the strongest indicators of economic health. When companies feel confident, they hire more workers. When businesses become cautious, hiring slows. And when companies start losing confidence, they cut jobs. So a sudden loss of tens of thousands of jobs raises a serious concern. Is the economy weakening faster than expected? But just as markets were trying to understand that shock, another factor appeared. Oil prices surged. Energy prices began pushing toward $90 per barrel. And that creates a completely different kind of economic pressure. Because rising oil prices often lead to rising inflation. Higher energy costs increase transportation expenses, manufacturing costs, and even food prices. That inflation pressure spreads across the entire economy. So now policymakers are facing two conflicting signals at the same time. A weakening job market suggests the economy may need lower interest rates. But rising oil prices suggest inflation might return, which means interest rates may need to stay higher. That conflict is exactly why the central bank paused. To understand why this moment is so complicated, you have to understand what central banks are trying to do. Their mission is simple in theory, but incredibly difficult in practice. They want stable prices and strong employment. If inflation rises too quickly, they raise interest rates to slow spending and cool the economy. If unemployment rises and economic activity slows too much, they cut interest rates to stimulate growth. But sometimes the economy sends mixed signals, and that's exactly what's happening right now. The labor market suddenly appears weaker. A loss of 92,000 jobs suggests businesses might be becoming more cautious about hiring. At the same time, oil prices approaching $90 threaten to push inflation higher again. Those two forces pull policy in completely opposite directions. If policymakers cut rates now, borrowing becomes cheaper and economic activity could increase. But if inflation returns, cutting rates too early could cause prices to rise again. That would force policymakers to raise rates later, potentially causing even more economic damage. So the central bank paused. No rate cut, no new tightening. Just a signal that they're waiting for more data before making the next move. But financial markets hate uncertainty. Investors prefer clear signals about where policy is heading. When policymakers hesitate, Volatility increases because nobody knows what the next move will be. And that's exactly what happened. Bond markets reacted quickly. Traders started adjusting expectations about when rate cuts might actually happen. Stock markets became more cautious. Some investors began moving money into safer assets. Currency markets shifted, energy markets reacted, and economists across the financial world began rewriting their forecasts. Just weeks ago, many experts expected several rate cuts this year. Now, some analysts are questioning whether cuts will happen at all, because if inflation returns, so policymakers may keep borrowing costs elevated longer than markets expected. So what happens next? Right now, three key forces will determine the future of interest rates and the economy. The first is the labor market. If the next few job reports show continued weakness, pressure will build quickly on policymakers to cut rates. Central banks take rising unemployment very seriously because a deteriorating job market can lead to broader economic slowdown. But if the negative 92,000 jobs report turns out to be a temporary statistical anomaly and hiring rebounds next month, the panic could disappear quickly. The second factor is inflation. Inflation has been gradually trending downward, which is why investors expected rate cuts in the first place. But rising oil prices could interrupt that progress. But if energy costs remain high or climb further, inflation could stay stubbornly elevated. And if inflation stays elevated, policymakers may hesitate to lower interest rates. The third factor is consumer behavior. Consumers drive a massive portion of economic activity. When people feel confident about their jobs and finances, they spend money. They buy homes, cars, electronics, and travel. That spending fuels economic growth. But when uncertainty rises, consumers often become cautious. They delay major purchases, they save more, and they reduce discretionary spending. If that happens across millions of households, economic growth can slow quickly. So the next few months will be extremely important. Investors will watch every new economic report closely. Job numbers, inflation data, retail spending, energy prices. Each report could shift expectations about what policymakers will do next. And remember, financial markets move based on expectations about the future, not just current conditions. That means even small surprises in economic data can cause major movements in stocks, bonds, and currencies. Right now, investors are entering a new phase of uncertainty. Maybe the economy is stronger than it appears. Maybe it's slowing faster than expected. Maybe inflation is about to rise again. Or maybe this was just temporary noise in the data. Nobody knows yet. But one thing is clear. The certainty investors had just weeks ago has disappeared. And when certainty disappears in financial markets, volatility usually increases. So watch the next economic reports carefully, because the story could change again very quickly. A single jobs report just shook the entire financial world, and the next one might determine whether interest rates finally fall or stay higher much longer than expected. If you want clear and simple breakdowns of the biggest economic stories shaping markets and the global economy, make sure you subscribe. Every week we break down what's really happening behind the headlines, so you can stay ahead of the next major shift in the economy.